Us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal studios. I'm Prashant. Sonia is out of action. We have Surabhi here over the next 2.5 hours. Nigel is joining in as always as well. Guys, hi. Good morning.
Good morning, Prashant. Good morning, Nigel. So today it is D-Day. I don't know what to call it. Finally, we're all set up, braced up for this all-important event that'll hit us, what's on 10:30 our time, I think? Around that time.
Yeah. When you said D-Day, Surabhi, I had all those images of troops landing on the beach in Normandy.
Well, the troops have landed, right? From the ECB to the Federal Reserve to the US Treasury. The troops are in the house.
You know, besides the big queue that we'll watch out overnight, domestically, and since we are in the state of Maharashtra, wishing all our viewers out there happy Gudi Padwa. So wishing all our viewers out there. Maybe volumes will be a little bit lower because domestic participation could be a little bit lower, but it's a good day nonetheless.
Oh, absolutely. Auspicious day. Money markets are shut.
Yes.
So it's ruby markets
holiday.
are not trading. So I think that's something to watch out for. But overnight, we have positive cues, right? I mean, I think that's what we begin the day with. And let's just kind of rewind back and tell you what's important as we begin another session. So markets overnight had gained for the second day in a row. And the Fed decision is later tonight. So you can say that the rally was into the Fed decision. Could you kind of say, well, this is in anticipation of what the Fed will do? Unlikely, because there's still a fair bit of confusion and division of what markets are expecting. So the changes are up on your screen. By the way, the S&P with a close above 4,000 is once again conquered the 200-day moving average once again. But, the point is the market has been so flat for so long in the U.S. That even some of these longer-term moving averages are very close by. Doesn't take very much in terms of a move for the market to jump above or below these averages. Now, there were reports which suggested that the regulators in the U.S. are becoming more comfortable to temporarily backstopping all deposits. We don't have anything sort of in terms of a confirmation, but more and more news reports indicate that that's something which they are open to doing. Data came in hot. And this is the conundrum which the Fed will face. The U.S. February existing home sales data was the strongest we've seen since July of 2020. Now, you can say that this is because, mortgage rates fell a little bit towards the end of last year. So this shows up with a lag in terms of more home purchases, etc. But it is what it is, and data is strong. Housing data is strong. Yields market responded quite aggressively. Up on your screen, the 2-year was up 19 basis points, the 5-year, the 10-year, all jumping back up. Now, we can get into the debate, but I think broadly what is expected is that the Fed will deliver a 25 basis point hike. Perhaps it will be accompanied by statements that say that we stand by to maintain financial stability, etc. as well. So you can kind of call it a dovish 25 basis point hike, but a hike nevertheless. By the way, I mean, if you want to look at what the Fed has done when they have been in a rate hiking campaign and there is financial stress which emerges, one should also keep in mind that if you compare the current period to previous episodes, inflation is high, unemployment is low compared to previous financial turmoil. So that's the reason why I think it's prudent to expect at least a 25 basis point hike. Now, coming to the market here, the Nifty saw a good rally. The Bank Nifty actually did even better. Banks did even better, private and public both. The Nifty needs to cross 17,180 for bulls to feel more confident. We're not very far away. It's about 70-80 points. That's the same 17,200 level. It's a downward sloping line. So 17,180 is that level which the bulls need to cross, which Nifty needs to cross above and close above for some more confidence to come back. That's basically a short-term reversal signal. The low, which is of 16,828, should not be breached on the downside for the Nifty. On the Bank Nifty, the 20-day moving average comes in pretty close by at 40,209. The 200, of course, we took out on the Bank Nifty, and 40,209 is a 20-day moving average. Again, a short-term reversal signal from being bearish to slightly bullish. And yesterday's low on the Bank Nifty, which was 38,941, is an important downside level, which should be protected if you want the market to stay more buoyant and stay more kind of resilient. Having said all of this, remember, we get the Fed decision only after market hours. We get it during US market time, and we will react to it tomorrow morning. So given that, I mean, if you are sort of not really itching to take a trade, and if you're trading very, very short term, perhaps it's just better to wait it out And I think the market will kind of reflect that in terms of trade today, as the SGX is also reflecting. Come back tomorrow, see what the Fed has done, what they've said more importantly, and then maybe take a position. If you're trading very, very short term, if you've got, of course, time on your side, as we've been saying, I mean, these are good levels after the correction that we've seen. Surabhi, hi.
Hi, Prashant. Well, absolutely. Actually, the SGX is far more modest than a lot of the other markets in Asia right now. For instance, Hong Kong and some of the other, even mainland Chinese markets are ripping away 2.5% higher. Yeah. So, I mean, in that context, the SGX is showing a very modest gain, at least for the time being. So let's see how that plays out. That's our neighborhood, which is looking actually even better. Prashant, just to take off from that point that you made about the perception that there's a permanent backstop, like a US government backstop now. So I was going through some of the commentary that appeared last night. And Janet Yellen was speaking at none other than the American Bankers Association. So therefore, you know that those remarks are obviously very, very carefully prepared and then delivered. And that's what she said. I thought I'd just put that up for our viewers. She says our intervention was necessary to protect the broader U.S. banking system, and similar actions would be warranted if smaller institutions suffer deposit runs that pose the risk of contagion. So when the regulator or when the government comes out and tells you we are there, the market listens, and I think that's what was playing out last night. It all really showed up in the way European bank stocks also moved higher. There were two pieces that were bothering the market. One, what's happening with the $17 billion bond loss on Credit Suisse 81 bonds. But yesterday, at least, the market seemed to be giving an indication that it's in a mood to move on. And that's what those stock prices indicated, including, by the way, Credit Suisse, which was up about 7%. Onto the Fed, Prashant has covered a lot of the ground there. Just want to say the probability, you keep looking at the Fed Watch tool, right? And the probability, at least as of about half an hour back, was 86% saying we'll get that 25 basis points rate hike. So let's see how that plays out. And markets across, I mean, whichever asset class you're looking at, equities, if you're looking at the dollar, which has been, moving back, moving a little higher, yields Prashant alluded to. Look at oil, there was a bit of an upbid on oil, gold was cooling down. So whichever market you're looking at, markets are positioned for this 25 basis points rate hike with dovish commentary, pretty much similar to what the ECB did, right? ECB delivered 50 basis points, but said, don't worry, we're there to step in whenever needed. And the market's expecting exactly the same from the US Federal Reserve. And the Fed rarely disappoints. And markets have cooled down as well as we're getting into the Fed meeting. So perhaps it's a lot better than where we were about 48 hours back. In India, of course, the volatility is ebbing. The VIX was down about 5.5%, 6% yesterday. Even the CBOE VIX, I mean, globally speaking, US markets, volatility is coming down. That would be good news for the Federal Reserve as well. FIIs have been net sellers. DIIs are offsetting that. The numbers are there for your screen. But this data is very skewed. We have so many blocks on a daily basis that X of blocks, what's happening in the market, a little difficult to gauge. But those are the numbers. Lots of DII buying even yesterday. Nigel, I think I look out for two questions, really. One, whether banks can build on the recovery. And two, whether Reliance can show more metal, right? Because these were the twin engines that were really firing up for the market. But I guess given the cues, I think we're probably set at least for a start on the upside.
Well, that's right. The SGX Nifty is suggesting a bit of a pullback to kickstart trade. And yesterday, in fact, we had a very, very good session because the Nifty Bank had conquered the 200 DMA, which was good news because at the start of the week, we started at the 200 DMA and it gave that away. So good to see that we pulled back yesterday. And there were signs of short covering, particularly on the Nifty Bank. Now, the problem is the Nifty is getting to that congestion zone, 17,150 to around 17,250. The bulls, they like to look at the 20 DMA, both on the Nifty and the Nifty Bank. But besides the Nifty Bank and Reliance Industries, I think today there'll be some support that could probably come in from the Nifty IT index. And I say that because overnight you have the Nasdaq that outperformed. And we have been seeing there is some correlation that plays out there. So the IT index today could come back. Yesterday it was the big drag. If it wasn't for the IT index yesterday, we would have probably been closer to around the 17,200 odd. What do the FIs do in the F&O market? Well, yesterday they gave themselves a break. They've been adding shorts non-stop, almost on a day-to-day basis. Yesterday they didn't do much, both on the short and the long side. The short positioning, as we've been seeing, is very, very aggressively net short, more than 90% on the short side. The options data was encouraging. They bought more calls than puts. They bought close to around 3 calls for every 1 put. And the biggest positive for me, which is telling you that there could be a bit of a near-term base, provided we don't get any fresh global negative news coming in there. They wrote puts. More than 80,000 puts were written in yesterday's trading session. And a couple of strikes I want to highlight. 17,000 puts, 17,100 put on the Nifty. Close to around 70 lakh shares getting added out there. So that's some writing that we've seen out there. And on the Nifty Bank, you had a lot of writing coming in at around the 39,500 put. The premium out there is around 100 rupees odd, which brings us to the levels. Very, very important. Since they're writing that particular put, well, on the Nifty bank, the support comes in at around the 39,400 odd. You deduct 100 rupees from around the 39,500 put. On the Nifty, well, you have 16,950 odd, so your Nifty could pull back close to 100%. But it seems if we don't get some, big negative cues coming in there, and if you get the 25 basis points odd, maybe the Nifty can move a little bit higher. Ideal situation will be the 20 DMA both on the Nifty and the Nifty Bank. SGX Nifty suggesting a green start. Maybe a day of consolidation would not be so bad, and the Nifty IT index could do pretty well today.
Things should look better, Nigel. We were discussing this on closing, I think last Tuesday or Wednesday, and at that point it was looking really tumultuous.
Yeah.
And we were saying that just maybe. First of all, this is not 2008, 2000. It's almost as if people who've seen 2007, 2008 want a repeat of that, just to kind of relive it because they probably...
I don't think so, Prashant.
No, it felt like that,
really...
right? And we were saying how maybe by the end of this week, right, things should look different. I mean,
and
next week should
look... talking yields. You're saying that yields, rates, inflation...
More normal kind of market, worrying about inflation and not worrying about a bank going under. Although this Credit Suisse and UBS thing perhaps added one more sort of bank into the mix, which was unexpected.
Yeah.
But the US thing has settled down. It's looking much better, I would say.
I was looking at a Bernstein report yesterday, and they listed out 5 key reasons why, in fact, 2023 is not 2028. I'll tell you why, 2008. The few reasons they said, the housing sector is in far better shape. The agility that the central banks have reacted have been far better. You didn't have that big gap. A couple of days, everyone came together and you saw things getting sorted out. And the data points as well are fairly good as well.
I'll tell you a simple reason. No one knew what subprime was in 2007,
Exactly.
2008.
Here, there's a tape
here it is it's a liquidity issue. It's not a solvency issue. In 2008, it was a solvency issue, which I think was the big difference. But
it's different.
It's different.
It is
different and it's completely...
As of now, and let's just hope it remains that way. That
I think we can say that it's different.
Okay.
All right, we'll get on with this now. Let's tell you what's lined up on the first half of the show. We'll get you updates from markets across the globe. Rajat Bhattacharya of Standard Chartered Bank will join us to discuss the global trade setup. Our research team will bring you CNBC-TV18's list of top 10 stocks for the day. At about 8:30 this morning, we'll do a fundamental stock analysis with Devin Choksi of KR Choksi Securities.
And on equities, let's get you the call coming in from Vikas Jain of CLSA, who says sentiment as per their proprietary India Bull Bear Index is 91% bearish ahead of the Fed meeting. He says barring the huge declines of 2008 and 2020, they have seen such bearishness 10 times in the last 15 years, and 9 of them were good entry points. He expects the Fed to raise market confidence and appear less hawkish, which may drive a sharp rally. To raise bets ahead of the event, he says they add Reliance, Hindalco and IndusInd to their portfolio, but exit Infosys and NTPC.
Well, the money market is shut today, so we have no money market calls. That's on account of Gudi Padwa, so have a good day, all of you. Well, but we have plenty of stocks, actually, that we'll be tracking for you today, and we'll get to that in just a bit in our special Top 10 segment. We're looking at a whole host of stocks, starting with Hindustan Zinc, Vedanta, Tata Motors, Bandhan Bank, Indian Oil, Zydus Life Sciences, Tata Power, and HG Infra. All the stocks on the back of positive news flow. On the flip side, you have Devyani International and Greenlam. Large trades taking place out there, so maybe some negative news flow on both of them.
Okay, well, let's get